And good morning, everyone. My name is David Schnitzer, and on behalf of Les Callahan, your 2022 CCIM Global President, it is my pleasure to welcome you to this special members-only event with our CCIM Institute Chief Economist, Casey Conway, Outrunning Inflation, the Commercial Real Estate Perspective. We'd like to thank all of you on this webinar for your membership and your continued support of the CCIM Institute and all it has to offer. You are the reason that CCIM works. And it's not just these webinars, but the value of lifelong learning, enduring relationships, and our shared experiences that make it work. Not to mention the right technology stack and deal-making solutions that bring it all together. So I'd be remiss if I didn't take this opportunity to mention the amazing new tech tools that are available through CCIM's site to do business. Market insights, instant insights, data links, map sites, and our very own CREPI index, which Casey will review a bit about. We will have some time for a few questions at the end. So please use your Q&A box for questions specific to this webinar, and we will get to as many as we can. And if you have any technical issues, please use the chat box. So without further ado, welcome Casey Conway, CCIM. Casey, take it away.
Great, David. Thanks for having me and everybody joining us today. Good thing to do in the middle of winter, right? So, and David, thank you and all of the CCIM leaders for your service. It takes a lot of volunteerism to make this organization run. So all of you that are serving in leadership roles, a big thank you. So we'll just jump into it so we can get more Q&A time here at the end. All right, there's my disclaimer side. As you mentioned, David, the title is, where can you outrun inflation, both property type and geography? And for those of you that have been out and had, a Chinese lunch or dinner this year, you know that this is the year of the tiger, and these rotate every 12 years. So if you worry about any Chinese zodiac symbol, this is the one I worry about the most. If you look back over the last 12-year increments over the last 20, 30 years, you'll see, take 2022 minus 12, what was that? 2010. I don't believe any of us want to repeat that. 2010 minus 12, you get 1998. That was, the Y2K and the tech crash. 1998 minus 12, we had 1986. That was the big tax law change that really was the trigger or fuse that lit up the S&L crisis. And then take 86 minus 12, and we get back to 1974, Watergate, and the beginning of really the great other inflationary period that we had. So anyway, disclaimer here, protect CCIM and everybody here. I am also serving this year as a board of trustee on the Appraisal Foundation. That was the entity that was created by Congress in the FIREA legislation. And it is a fun and interesting time in the appraisal world. Again, if you're just go to HUD.com and you can see some of what's going on. All right, so what are the extremes in this year of extremes that I'm worried about? So we all know we're worried about the Fed and the FOMC meetings. They did not move rates in January. I think that was a big mistake. So now it's going to be until late March that they actually have another meeting. There'll be none in February. And I think the debate's going to shift to whether they maybe even have to do a 50 basis point increase that they're so far behind. COVID variants and vaccination mandates, everybody's handling them in different ways. And how you respond to those is going to have very different effects on your economy and your real estate values. Supply chain disruption. I pray like the Dickens that within 2 years we never hear this term again, but we're going to be living with this term for quite a while. Midterm congressional elections, go back to 1990, and I warned about pay attention to the 2020 elections and that they could be very, very disruptive. I think that what we face here in the midterm elections could be more volatile. Our country's more divided, and I don't think either party or political ideology can really accept a lost result. So I think these are going to be a very difficult time. I'm recommending, including myself, to go on vacation after I've absentee voted and not be in a big city. Geopolitical risks, we know about those in energy and what's going on with Russia and Ukraine. And really, it's a broader picture about what happens to NATO and the implications for us in the US. And the last one that I kind of want to put in there is commercial real estate values and we're entering an era that we haven't had for a long, long time. And that is where expenses are growing faster than revenues or rent growth. And if the Fed follows through on interest rate hikes, and I don't think it's 2 or 3, that typically once the Fed starts, it's about 8 in a 2-year period of time, the cap rates have to go up. So if you have rising cap rates, expenses outgrowing revenues, what has to happen to commercial real estate values? They have to correct, and they're not going to be what they've been the last 2 years. So we need to get ourselves and our clients prepared for that. And I'll talk about that a little bit here. All right. It's frozen up here, but there we go. So if you have any doubt about this is the year of extremes, I'm going to give you 2 good examples from Florida to Texas. So in Florida, at the end of January, the National Weather Service had to issue a falling iguanas weather service alert. I'm not kidding. I'm not making this stuff up. It got so cold in South Florida that the iguanas that live in the trees and all, they just kind of went dormant and started falling out of the trees. And believe it or not, if you're visiting Florida in a winter or cold period of time, it's against the law to pick them up and bring them inside and warm them up. Maybe we should adopt that philosophy for politicians. If they fall out of the tree on their head, don't pick them up, revive them, just let them be. And then in Texas, David discovered a new kind of fishing in Texas. So right at the end of the year, you get these water spouts, the way the weather works and the storm fronts, and they pick up marine life, fish and crabs and frogs, and they carry them inland and then they start to fall out of these water spouts. And so it was actually raining fish in Texas almost going into the new year. So these are pretty extreme events. So I think this tiger thing is right and concerns the heck out of me. I want to get through this year quickly. All right, I'm going to talk about a few economic influences here. And these are what I think are going to really be driving us through the year. And so on the far left there, I've got the Federal Reserve and FOMC, and then in the middle I have inflation, and on the far right I have logistics and black swans. So there's 3 things I want you to take away on the Fed. So the first is I have a calendar of the meetings, and you see highlighted in yellow there in the upper left, there's no meeting in February. So the next meeting is mid-March. And I think they have to raise rates. And then it'll be, do they do it every other meeting, or do they follow through 3 or 4 in a row? But once the Fed starts, I'll share with you in a minute, they don't just do 3 or 4 hikes. They generally have never done less than 8 once they start. The other thing is pay attention to which Federal Reserve district you're in. It's time to start paying attention to the beige book and the comments from each Fed district and what they're telling you about your district that could be very predictive for commercial real estate. I've highlighted the Atlanta and San Francisco district banks here. Atlanta is 6 and San Francisco is 12 for the following reason. These are the 2 Federal Reserve districts that have the most ports in their district and handle the most supply chain. And guess what? Neither one of them do any research or regular intelligence monitoring on ports and supply chain. The Atlanta Federal Reserve District has the most. It has over 20 ports. So you've got starting in New Orleans all the way through the Gulf Coast around Florida and up through Georgia. They don't have the Carolinas. Those are in the Richmond Fed. They have 20 ports, and those 20 ports handle more than twice the supply chain and containers that the ports of LA and Long Beach do. You don't hear any of that in the media. And so one of my hypotheses I'll get to is that we're going to remake our supply chain from being so dependent on the West Coast, moving things inland to Chicago and the East Coast, to we have the infrastructure to make it a north-south supply chain and move from the Gulf up into Canada and vice versa for commodities and stuff. So that's going to be a big one. In the middle, inflation. I want you to understand this CPI thing. So when I was at the Fed 2005 and 10, we actually went to stores and we bought our basket of goods and we looked to see what had occurred in prices. Well, the first thing I learned was that basket of goods is not static. It changes. And so if you go back to, the 2000, after the 2008-9 housing crisis, home prices were falling. And so shortly after that, the BLS and the government changed the weighting of shelter and housing from 40% of the CPI composition down to 25%. Why did they do that? They didn't want deflation. So by lowering the weighting on shelter and an asset that's declining in value, they said, see, not much deflation. The same is going to happen here in reverse order. So going into COVID, we were seeing that housing had gotten a bigger share of the CPI index. It was up to almost 43%. So if now you're concerned about inflation and houses are running double digit up to 20% in many states and markets, how do you show the CPI is calming down and we're not having inflation? You lower the weighting of shelter. And this gamesmanship goes on. And so that's what I want you to understand, what's kind of going on with the CPI. On the other side is the logistics and supply chain and black swan events. And this is what concerns me the most. I think we have more black swan events to be afraid of. This Russian-Ukraine thing is huge. It's not about, Russia wanting the Ukraine or any of these other things, or really energy between Germany and Russia. It's really about destabilizing NATO. And we need to kind of go back and do some history lessons there. Cyber attacks concern me tremendously. Look what happened last summer with the Colonial Pipeline from the Gulf in Texas all the way up, through the Southeast and up into Pennsylvania. A little cyber attack shuts the whole thing down for several days. And of course, I live in Atlanta. And we couldn't handle being 2 days without gasoline. It was just absolute chaos. So these are the things I think that are going to be driving us this year. And some of you have seen this slide from me, and I've visited a number of you so far in Miami and Milwaukee and Las Vegas and Houston already, and you've seen this. This is a slide I'm going to keep in front of you all year long. This is my inflation slide. This is my backup for why I think we're headed back to a true 1970s inflationary cycle. So the blue line is inflation. The shaded areas are when we've had it really high. So 1940 to 50, this was World War II, the end of World War II, bringing GIs back home. And this is when the Fed got its first mandate of full employment. As we converted, from a wartime to a peacetime economy and brought the GIs back, Congress wanted to make sure that the GIs were able to get reemployed and said, Fed, that's your job number one. Then we got to the 1970s and they got their second mandate, price stability, that came in the Humphrey-Hawkins Act in 1978 with our inflation. So this is where they came from. And in the upper right corner, this is kind of my short hypothesis on why I think we're headed to the 1970s again. The first thing is we're in a period where we've had rampant deficit spending that's totally out of control. We had the same thing in the 1960s going into the 70s, but it was caused by the Vietnam War. In 1971, we had Richard Nixon take us off the gold standard. I think when we write the book on crypto and Bitcoin, we're going to find this was the absolute beginning point of the creation of Bitcoin or a digital currency. We became a fiat currency. There was nothing backing our dollar. And this had a big part of what happened later in the inflation cycle. 73, we had the oil embargo, Arab embargo, and an energy crisis, an energy supply chain disruption. And that energy supply disruption essentially basically is the equivalent today of what of our supply chain. So, history repeats itself, but for different reasons. So energy was a much bigger part of our GDP and every part of our economy and our expenses. And so too, we're discovering the supply chain today. But President Nixon, he had a great solution for stopping inflation. He had a gimmick called price controls. He put those in place and said, see, no more inflation. Well, that didn't work out so good when Ford and Carter had to remove those. The equivalent of that gimmick today is the Fed's balance sheet. So what the Federal Reserve has been doing really since the great housing crisis and the Great Recession is anything that wouldn't sell. If a mortgage bond or a 10-year treasury wouldn't sell at a price where they wanted interest rates to be or mortgage bonds to be priced, the Fed intervened and bought it at the price they wanted it to be. Well, now the Fed's telling us they're going to taper off the balance sheet. Well, what that means is we have to find a greater fool theory. Greater fool theory is who is going to be foolish enough to come in and pay the prices that the Fed has been on mortgage bonds, 10-year treasuries at 150, municipal bonds, and even corporate bonds last year. Who's going to pay the same or a better price? And the answer is they're not. China, Europe, pension funds, they're not going to do it. They're going to demand a true market price. We can get true market discovery. And this is what's going to push the 10-year treasury and these other instruments well above 2%. I think we were at 195 this morning. Remember, we were just at 145, not even 45 days ago. So these are the things that are converging that we haven't seen come together in four plus decades, and it's my thesis on why we're really headed into a 1970s inflation cycle. The next thing If you don't believe me about inflation, I share this stuff with the Fed. I do briefings to the bank regulators every quarter, and I share this stuff with them. You know, they're looking at bad data. They're looking at stale data that's revised. They're looking at government data. They're not looking at industry data. So number of you know that I'm a big fan of E&R Engineering News Record, and they track all of the construction contract bids from contractors all over the country for projects 2 million and above in permit value. And look at what they were telling us last spring at the bottom. They were telling us that construction costs and building costs were fairly tame. So construction is the materials and building is materials plus labor. So materials are running about 4% a year ago, and building materials plus labor was running about 6%. Look what happened in the fall, September, October, and look what's happening even through this year. Those doubled, and we're now at 8% at least on materials and 14% on materials plus labor. And they do a city index to look at how that overall national data translates. So they have 20 cities, and I want to point 3 out. So New Orleans has the highest. They're running at 35%, and that's driven by the fact that they're rebuilding from hurricanes, the whole Greek alphabet from essentially 1.5 years, 2 years ago. After that, look at who's number 1 and 2 in the most cost increases. It's Atlanta and Dallas. And the year-over-year numbers for Atlanta are almost 25%. And for Dallas, it's 22%. And what this means is my point there on the right side, this is a real CCIM opportunity to aid banks with evaluations, financial analyses on the cost overruns of projects and what the new completion value really is. Appraisers look in the rearview mirror. They don't look out the windshield. They're going to give you the old comps from 2019 or maybe the distressed in 2020. And the banks are going to need a lot of help sorting this out because of cost overruns. If you have a 2-year construction project, you're looking at 40 to 50% cost overruns. And who's going to pay that bill and what's going to happen to that loan if it can't move into the permanent market and it's got to be a bridge loan or something like that. The other thing about inflation that the Fed can't control is other countries are exporting their inflation to us. So I said, we know Asia's doing it big time in China, but let's look at a closer neighbor, Mexico. Mexico's running over almost 7.4% inflation. They manufacture many of the components that we need in automobile manufacturing and all kinds of manufacturing and agriculture and stuff that goes into our food prices. And so if they're running 7.4% and we're a big import nation, we import now much more than we export. And so we've got that inflation problem. How is the Fed going to tell Mexico that stop it? We're going to do something to slow down your inflation. They're not going to be able to do that. So I'm very, very concerned about that and the export of inflation. Commercial real estate values. We've had a great run, believe it or not, the last 2 years, probably the greatest we'll ever seen in a post-World War II environment. So Green Street is one index. Real Capital Analytics has a better one that goes granular to local markets. But Green Street has told us that commercial real estate prices are now 14% higher than before the pandemic. And in the past year, they went up 24%. And they were led by self-storage, up 66%. Then industrial, 41%. And believe it or not, a tie with lodging and strip retail. Not malls, not big box anchored, but they're up respectively 30 to 32%. And poor old multifamily, it could only go up 29% last year. These are unsustainable numbers. We don't see these. This has to begin to unwind this year and next year, especially as expenses are greater than revenue growth and cap rates, either the compression has to stop or cap rates actually go up as the Fed raises interest rates. Go back to your band of investment and math formula and mixing debt and equity. And if each of those go up in cost, your cap rate has to go up. I want to give you a new tip to watch this year. And this is your precursor for when to take a lot of Tums for heartburn or to get the heck out of the market and buy more real estate. And this is the VIX. The Chicago Board of Equities publishes the VIX. And what they tell us, the green line is the history of it. And when it's generally below 20, we have pretty calm in the market. The market's comfortable with what's going on and how government's working. When it gets above 30, we get a lot of anxiety, market sell-off, a lot of turnover. Everybody's 401ks gets hammered. And I want to put some of these numbers in perspective. In 2008 and 9, the VIX went up into the 50 to 80 plus range. It reached an all-time high in November of 2008, March of 2008. And then March 2020, it hit a new high of 82. So if 20 is calm and 30 is when we start to freak out, can you imagine where the market gets when we get into the 50 to 80 range. And fortunately, we're not there. The VIX has slid back below 30 again, but it's not going to take much of a sneeze or a cough or a misstep or Russia actually moving into the Ukraine, oil going well over $100 a barrel, which I think it will do here before this first quarter is over with, and the trickle effect of that. We're basically paying double what we were for energy a year ago. And so what is really going on to cause this VIX to have this volatility and 1,000-point intraday moves in the stock market? And basically, and this isn't a political statement, this is just a factual statement, the markets are growing and the public are growing fearful of the ability of the Biden administration, the Centers for Disease Control, and the Fed to have competency to manage COVID, inflation, and geopolitical risks. We're losing faith in those three pillars that influence our economy. And that, I think, will have a huge impact on what happens in November of this year. The next one is to pay attention to what happens when the Fed finally does move on interest rates. So on the far right there, I have the 10-year view. So this goes back to when it really ramped up in the spring of 2019. Many of you remember the taper tantrum in 2018, the 4 rate hikes. And basically the Fed moved 8+ times, and they moved the rates from basically a 1/4 point to 2.4. So that was a pretty big move. Imagine if we just layered that into what we got right now, the market would totally freak out. And then look at the 20-year view. And if you look at between the summer of 2004 and 2006, when home prices were really booming before the subprime mortgage crisis, I was at the Fed during this period, and they thought they could raise rates and pinprick and perfectly land the housing crisis. And they moved rates from 1% to 5.25%. And I think we could see at least that kind of move here, if not a lot greater move, because then it was really looking at housing, where now we're looking at inflation being much more systemic and in things like wages, which are really sticky. Here's the other thing that the Fed cannot control that is going to move interest rates higher, even if the Fed sits on its hand and says we're not going to do anything at all here and just hope it all gets better and that it's all transitory. And this is our debt situation. So on the far right there, I had to cut this graphic a little bit, but it's Visual Capitalists, one of their top 20 graphics for last year. They looked at our national debt over the last 120 years. And you can see it looks like an hourglass, all the sand, all of our wealth, all of the value of our currency bleeding out. And if you look at the table on the left, go down to 1990 and look at 1990 to 2020. And what you can see is since 1990, every decade, we have racked up more debt than all the previous decades combined. This is unsustainable. This is like a consumer, my millennial daughter gets 5 new credit cards with a $10,000 allowance on each, racks them all up. What happens to her credit score? It goes to hell. And now she's not borrowing at, below 10%. She's borrowing at almost 20% till she gets that debt under control. We are becoming a bad credit risk to the rest of the world. And the Fed isn't just battling inflation, it's battling fiscal deficits at the congressional level. If we don't tame this and tame it really soon, I don't know where you put the interest rates. The rest of the world is going to look at us as a bad credit risk. So this is the piece the Fed won't talk about, that they're not connecting the dots to. They're still in denial over this one. All right, jobs. We saw last Friday, last week, we got dizzy. ADP came out and said, hey, we've got great, several 100,000 jobs in there. And then the BLS comes out on Friday, and we all expect it to be under 200,000 again, or maybe negative or zero. And they come out without over 400,000 jobs with a lot of upward revisions. And so the thing to pay attention to the Fed is over the last year, their revisions have been more than 1.2 million to the upside. That's how much they've been missing it month after month. And the reason is the BLS is undercounting jobs. As many of us have gone to remote work, we started our own businesses, we become subcontractors at home, doing things other than what we used to do. The Fed doesn't know how to count that. They only know how to count payrolls and where you're having withholding done. And so like my little company, Redshoe Economics, we just got picked up here in February as a company and employees. And for the last 14, 15 months, they thought me and Beverly and Kaylin and Stacy, our four teammates, that we were sitting at home on a couch eating chocolates and just enjoying life and getting government checks. And so they didn't count this stuff. And so this is why I pay attention to ADP more than I do the BLS. The ADP has been telling us we've been producing over 500,000 jobs a month. We have unemployment that's in the 4% or less range. And what happens in February of every year is all of the states report to the BLS their state level jobs. So they pick up new company formations, subcontractors, all of that stuff. They report it to the BLS. And that's why these numbers went up so much in February. We got the true up, what they call benchmark revisions. But the Fed is just grossly miscounting jobs, particularly the self-employed, the subcontractors, and the new business formations. The thing to pay attention to in all of these wage reports is not whether the numbers plus 200,000, plus 500,000, or minus, or a million. It's what's happening with wage inflation. And what they're telling us is that we're running about 0.5% or more wage inflation every single month. And that's unsustainable. You give somebody a raise, you can't get it back. You hire somebody and then they quit on you 90 days later to take a job that's paying 25% more. That's real stuff that you can't get rid of very quickly. It takes years to work that out of the system. All right, I want to introduce two other concepts. Zombie. This isn't a horror movie. It's not Halloween. This is February. But zombie real estate companies, they're back. And our industry is front and center in focus, and we have the most zombie companies. So what is a zombie company? It's a company that's making a profit, but it's barely making enough to pay and service the interest on its debt. So if rates go up, they're wiped out. And for all companies in the US, we're running about 5% are zombie companies, which is really not that bad considering the pandemic and what we've been through. But in our commercial real estate industry, we're running 50% more than that, almost 7.5%. So these are mortgage companies, brokerage companies, property management, all originators, loan and debt originators. So this is a term you're going to hear a lot about. This is also an opportunity for CCIMs because these companies need to segregate the real estate from the going concern value. And so we have the training on how to do that. The next one is zombie home mortgages. So we're now seeing we had over 33,000 mortgage modifications. 98% were multiple combination modifications. It wasn't just we'll stop paying for a while, or we'll modify the interest rate, or we'll put the debt to the back. It was multiple of these things. And what the National Mortgage News in a study they just published is telling us is that we could face in these zombie home mortgages and loans a crisis that is that'll rival what the CMBS industry went through after the Great Recession, Great Housing Recession. And what they do is they just recirculate. It's kind of like the interest only on CMBS loans. The Fed let everybody do interest only, not put any debt service, and repackage and sell these things for a gain. The same thing is happening here. So we have a lot going on in the background that could really come up and bite us later this year and next year. All right. Let me give you a good piece of news. David mentioned this a little bit, and you saw if you went to Pittsburgh, you got introduced to this by Stan and Mark Seipert and Carol Campbell, but we have the CREPI index. And so I get questions all the time. Where do I find it? I can't find it on ccim.com. It is on the Site to Do Business website, and it's free for your clients and you, even if you don't have a Site to Do Business pass. So on the right there is what the screenshot looks like. Carol and Stan and Mark done a good job. They got the red arrow pointing down to it. There's the thing, you click on it, it opens it up. I'm writing the narrative. We got the first one done, the second one for the end of last year, we're just finalizing right now. And what this index does is we tried really hard to keep it simple and understandable. It's 10 metrics. We picked 10 that have a sampling of confidence, business and consumer, sampling of employment, sampling of inflation, sampling of commercial real estate conditions, all of those things. We put the 10 together and we back tested them all the way back through the past recessions and recoveries to see how that index performed. And it tracked almost spot on with everything. So it's a simple one you can share with clients. We'll update it quarterly. Not all of these have the same date that they release data. So when we issue a CREPI index, let's say it's mid-quarter, let's say right now we're mid-February, and we have something that doesn't come out until the end of February, 1st of March. That metric will include what the most recent published piece is, and we'll pick up the new one. So there'll be some movement. We'll talk about that in the narrative, but this is a very reliable thing. It's very simple. It's something you can share to your clients and really add some value to them. All right, we're done with inflation. We're scared to death. Let's go on. Let's talk about some good news. The good news is population migration. So most of you know that my favorite Christmas present every year comes in January with the moving company reports, U-Haul and United Van Lines. And some really interesting things occurred in this year's data. So the U-Haul I like because more people move that way, and U-Haul reports it not on percentage of move-ins and move-out, but actual count. And so last year, 5 of the top 10 states were all in the South. This year for 2020 or for 2021 period, the top 5 were all in the South. So whether you like the South or not, whether you like okra, whether you like barbecue sauce or grits, it just doesn't matter. This is where people are moving. And a lot of it is predates COVID, trying to escape bad affordability options in, say, California, New York, and the West Coast. So Texas regained its top spot, followed by Florida, Tennessee, South Carolina. And look at the Intermountain region. Really, if you look at from Boise, Idaho, Salt Lake City, come on down through Wyoming, Colorado, even into Arizona, very, very strong. I just spoke up in Milwaukee to the Milwaukee Commercial Association of Realtors of Wisconsin and CCIM chapter. And believe it or not, Wisconsin was number 13. And you might be saying, why would anybody want to go to Wisconsin? Why would anybody want that cold weather? Well, Wisconsin's got a lot going on for it. So these are why these reports are moving. I give you one example. Generac is building a big expansion of their home and business generators for all of the storms and disruptions that we have. And they find the workforce is there, the workforce is stable, the affordability is there. So it's not just all sunshine in the South, but it's places that have all the other boxes checked as well. So to our friends in Wisconsin and Milwaukee, you're doing just fine, and you deserve a little love today. So we're giving you that love. The other one is the United Van Lines report. The United Van Lines, I don't like as much. Number one, it's just corporate moves. So only if you're government or work for a big corporation that can pay to move you do you get counted. And you'll notice on the far right there, it looks at the percentage of inbound, and that's what determines your rank. So Vermont ranked number 1 in the United Van Lines with a total of 307 moves. Give me a break. Look at Florida on inbound shipments. 13,000. Look at Texas, 12,000. Look at North Carolina, 6,000. So although the percentage is a little not up there at 74, it's in the 60+% range. These are the absolute numbers, and the absolute numbers is how U-Haul works it. But pick the one you like for your own reasons. But anyway, put the numbers in perspective, because as Gary Ralston will always remind us, we can get statistics to tell us any kind of story that we want, but try to find the right one. The other one we know, if you've heard me talk since the end of last year when we got the census data, is the census data validates the moving data. And it tells us that where the population has been moving, not just during COVID, but for the whole past decade. And they've been moving to the Intermountains, Idaho, Nevada, and look at Utah, 18%. It is absolutely incredible what's going on with Utah. In fact, most people in the Salt Lake CCIM chapter will tell you the only thing worse, maybe worse than no growth, is steroid growth. You just can't manage this kind of rapid growth. The other is the South, so you can see Texas and Florida, but look at the Carolinas, 10%. Look at Georgia, and then poor Alabama. They just didn't answer the census surveys because they were taking them during the SEC football season, so I just don't think they got properly counted. There's a lot of good stuff going on in Alabama. The other one, hopefully you all have found that ULI released their 2022 Emerging Trends Report. And it's one of their best reports ever. And they now give you 3 levels of rankings. They give you an overall ranking in the middle, and then they give you on the left an investor one, and then on the right they give you a construction, where people are interested in doing new development and construction. So a couple things I'll note here. So to our friends in Tennessee, Nashville was number 1 in 2 of those rankings, and it was number 1 or 2 in all 3. What's happening in Nashville and Tennessee is phenomenal. Number 2, Raleigh and Charlotte, North Carolina, very top. Raleigh was number 2 or 3 in the overall ranking and for development, and it was in the top 5 there for investor demand. So this is where people want to put their capital work by assets, and where they'll look at development. There's a key point in the development on the far right I want to draw your attention to. For the first time ever in ULI's history, there was no MSA where any participant, no ULI member or participant, ranked a city as very strong for new development. And you might be scratching your head going, why? And the reason is nobody can budget for it. How do you budget to develop when you have 25% annual construction cost increases in Atlanta and Dallas and 15% overall? And so it's really that lighter shade of green where people are trying to figure out how to make things work. They know the demographics are there, the population growth is there, but this is a report definitely worth your time in reading. So many of you are familiar with the Counselors of Real Estate, like CCIM Institute is an affiliate, and we do our annual top 10 report. I'm always a little bit of the contrarian. I've been doing this for all 13 years that we've been doing this annual report. And so I wrote the adaptive use and logistics pieces for last year. But I really thought, because I thought it was time, I was a little premature to get energy on the radar. Where is energy? And I believe that energy is the #1 issue affecting commercial real estate after inflation. And I want to share some with you. I just did a presentation in Houston. The Colliers had their annual Houston Trend event. We had probably 600-700 people. Biz Journals covered it. You click on their site and they've got a good thing, or just send me an email. So I want to start with a couple of things. Whether we like it or not, without petroleum and natural gas, it's lights out for the US. So if you look at the black and blue lines, you can still see that 2/3 of our economy at every level, residential, transportation, business, manufacturing, we're dependent on petroleum and natural gas for our energy source. And we do it cleaner and better than anyone else in the world. So when China and India and Russia all want to complain, and Europe, that we're not doing enough, we have the cleanest air, we do the cleanest manufacturing, the cleanest transportation as anywhere in the world. And if you look at the bottom, the green and red lines, you can see what's happening with nuclear and renewable energy. And we're going to struggle to ever get probably close to 20%. So we're going to have to figure this out. And it's going to take many years, if not decades. And you can go to the EIA's website. This is their January report. These are their numbers, not mine. And this isn't a political statement. This is reality. And so here's Texas. So I was down there in Texas, and we need to give Texas and Dave Schnitzer a big hug, because if we're not nice, we might have our own cold winter and lights out ahead. So I claim that without Texas, it's lights out and no electric vehicle charge ups without Texas. So if you go down up on the left there, you can see Texas is first or second in every energy category except one, hydroelectric power. And they make up for that when hurricanes hit. They generate a lot of hydroelectric power with all the wind. Texas also leads the nation in crude oil refining. So if their refineries go down or they have a fire or whatnot, we are all in a world of hurt. In 2020, the state of Florida produced 1/4 of the nation's natural gas. They are very important, to us overall. And there at the bottom, Texas produces more electricity than any other state, even if it freezes up like it did last winter, and they have their own problems. They're fixing all those. The other one I want you to pay attention to is on the right there. This is the Colonial Pipeline that emanates in Texas and Houston. It goes all the way up the East Coast, through the Southeast, all the way up into Pennsylvania. Without this pipeline, without this natural gas and refined gasoline, essentially about half of our country does not have energy. So whether we like it or not, we really need to understand energy again and how it fuels our real estate. What does it cost? Why do they move manufacturing? Why do they move site selection into basically the states that are along this pipeline? Is because they have access to affordable and reliable energy. So I think energy is one of those things, whatever our view is, we need to put it on the radar screen. This is not going to change in the next decade. We're going to be very dependent on oil and natural gas. All right, let's talk about housing. It's very important. I know we all do commercial real estate, but we understand what's happening with housing, because commercial real estate, it follows the rooftops. And like in the great housing crisis, if no one's in those rooftops, commercial real estate gets hit. Well, when you look at where the rooftops are being built, half of all new homes are built in the South. Just a reality. So when you look at where commercial real estate is probably going to do better, where there's new household formation to shop and buy goods and go to the office and run a business, it's going to be in one region of the country. So those of you that are in the South, those of you who have clients looking at where they should expand or diversify, this is going to be one of the answers. This is where the lead's going to be. There's another housing influence. I just spoke to a major home builder in the home builders in North Carolina last week in Charlotte. and we talked about, what's going on. So National Public Radio had this piece on, and they talked about, well, if the builders would just build more homes, we'd all be okay. And it wasn't until literally the last 5 sentences of this story did they get to the crux of the matter that's affecting housing. It's kind of like on supply chain. It's not just that we got to get everybody, working 7 days a week on the LA ports. This is what's happening. We have had overly restrictive zoning embed over the last decade. We've had building materials go up. We have labor shortages. We have it difficult to get land rezoned and entitled. Every NIMBYism group, not in my backyard, comes out anytime somebody finds a 1, 2, 300 acre tract of land that's ready for development. And they thought, well, that's where my kids have been flying kites, and you can't develop that now. If we don't look at how we can utilize land and not layer in these costs, we're right now looking at about $50,000 in the cost of a new home is to deal with the regulatory and zoning issues. And so we got to look at your local communities. We've got to engage. When you look at economic development, if you don't have housing, if you don't have affordable housing, companies are not going to come there and put facilities. All right, so what are one of the solutions? I've talked about this before for affordable housing, and this is for rent subdivisions. And this is a company, American Homes for Rent, public company. They're just crushing it. They're simply all over the country. I put some arrows over there on the right in cities like Raleigh and Charlotte and Orlando and Texas and Denver, where they're developing. They have developed in the last 5 years 56,000 for rent homes in subdivisions in 22 states, and they're 97.5% occupied. It's basically move in, move out with rents going up. Our millennial workforce, they don't have the credit scores, they don't have the cash down payment, they don't have the financial structure to go buy a home, but they need a home. They don't want to be downtown. They want to be in the suburbs. They want to be remote. How can they be in a home, get married, start families? Their path to home lifestyle is, it may be a rental rather than an ownership structure that it was for us. So if you haven't spent time with one of these 7 large public for rent home builders, to talk to them about their struggle to find land and how they could use CCIMs to do site selection and understand their model and what the ratios are between the land cost, the raw land cost, the finished lot cost, to the finished home and the rental and the return on that, I really encourage you to do it. This is a huge, huge opportunity for CCIM business. Multifamily, everybody take a deep breath. It's going to be fine. 148 of our 150 largest metros have a 96% or better occupancy rate. And so when you hear the panic by those saying, oh my God, we're going to deliver more apartment units this year since 1987, 426,000, don't freak out. We typically build between 350 and 400,000. So this is only about a 10 or 15% overall increase. And we're starting with a 96% occupancy. We got to look at the numbers. We got to look at what percentage are affordable versus just, a luxury at multifamily. But multifamily will not implode in 2022. All right, back to work. Most of you have heard me talk about the Castle Back to Work Barometer. So we, believe it or not, before the end of the year, we got up to, almost 40% of us were going back to the office. It has slid back to below a third, 31%. And the places with the most people going back to work, they're in Texas. Texas was over 50% in Austin, Dallas, and Houston. They still lead. Austin's number 1 at 43.5% and Dallas at 42.8%. If we don't see this number really by the spring or summer move well above 50%, we're going to begin to see the unwinding of at least urban office. And my hypothesis has been for the past year that when we look back on COVID, the asset class will have been the most beaten up will be office. It always is the last to go down in the trough and the last to come back up because of the longer term of leases, strategies like sublet, leasing or whatnot, a vacant space. The other one is check out Real Capitalytics. They're the only entity that break out suburban and CBD office. And what they told us for last year is CBD office lost 4% in value. By the time we get through this year, it's going to be 10 or 15%. And suburban actually went up 15%. if you're in office and you're not working on and looking at suburban office alternatives, branch banks that you can lease and buy for 50 to 60 bucks a square foot. I work with companies that are trying to buy and lease all the ones they can. The FDIC just announced it was a record year of branch bank closings last year with over 3,500 nationwide. They've got an inventory of stuff for sale that's in the 5,000 to 10,000 branches alone. But suburban office is going to be strong. If you're not working and focused on that, you're really missing a huge opportunity there. Look at the REIT returns. I want to talk about retail here a little bit. So our former last year's CCIM Institute president, Tim Blair, is credited with developing this term, influence density. This is all you need to know about retail. Where retail is working, it's not working at a mall, it's not working in a big box store, but it's working in neighborhoods where you have the combination of a density of households that also have wealth or good incomes. And so when you have that influence, which is wealth and household income and jobs, and you have density, lots of them, that's where strip retail is working. And if you look at the numbers from the REIT returns, strip retail, something near a Walmart, near a number 1 or 2 anchored grocery store, they are doing very, very well. And they're filling up with more service type tenants than they are good selling tenants. In fact, last year, the number 1 shop type under 4,000 square feet tenant leasing activity was in pet related, pet salons, pet grooming, pet babysitting, pet daycare, you name it. That was the number 1 tenant category in strip retail last year. All right, there's a couple of others. Pay attention to grocery. Grocery is again the new anchor. And so dunnhumby came out with their latest rankings here that I put in here. Amazon, HEP, Market Basket, Wegmans, Amazon Fresh, Aldi, Trader Joe's, Sam's Club, Costco, and Walmart Neighborhood Center are the top 10 grocers in the market. So when you're looking at marketing a portfolio, marketing an asset, getting an investor to go in, if your strip retail is not within a grocery anchor or in proximity where you can view it, see it, pass it on the way to the grocery store, of the number 1 or 2 dominant grocer in your market, you probably are going to have a tough time selling it. 1 and 2 dominant grocers are just crushing it. They're the new draw, whether it's BOPIS, buy online and pick up in store, or whatnot. You'll see in this next slide, kind of the reality. Actually, maybe it's at the bottom of this one. They just did a survey and they found out that half of the US grocery and shopping population does not buy online and has no plans to. So do we convert grandma and grandpa? Do we convert others that maybe aren't as technology adept or more rural tertiary markets? Can we change that? I think we will, and we'll see this change quite a bit as well. Here's the good news. We closed 65% fewer stores. They were down. This was after a record 9,000 store closings in 2019. I don't know if this is a delayed effect and that we'll see this pick up after COVID. Will it be an echo to this? I kind of think there will, but hey, we'll take all the good news we can take in retail these days. Retail, a couple of things to keep in mind. So on the left here, we're not buying more. So when you hear the volatility in retail sales, that October was a record, and then November and December fell off the cliff, and December was the worst that we've had in a December, understand that what's going on. Look at quarterly data. Take October, November, December, add them up, average them, and compare them year over year. And what you'll find out is that because of COVID and the panic this past year, everybody moved their November and December shopping up into September and October. Does that stay with us? We'll find out here with the COVID variants, but basically retail sales have not gone down. They're not going up rapidly. What's going up is we're paying more for the same stuff. We're not buying more, we're paying a lot more. Grocery and beverage store sales increased almost 9%. Sporting goods stores are up over 20%. So if you want to know what categories to take a look at. And National Retail Federation, which I believe a lot more than the government data, they told us that we still had a 13.5% increase in U.S. retail sales in December. So again, they track it at a good local level. All right, let's talk about logistics. Some of you have heard me over time talk about the Golden Triangle. This is the area from the Great Lakes down through Arizona and Texas and across the Southeast. This is where 70% of the U.S. population lives east of that, within it or east of it. It's where 80% of all manufacturing and major new site selection announcements are done. And it's where all of our logistics infrastructure is, the most ports, the most class 1 railroads. And so this is a really vital area. And if you're within it, you need to be able to tell the Golden Triangle story. And here's a picture of how important rail is. These lines are the spaghetti graph of the class 1 railroads. And you see the gray over there in California, Union Pacific. And then you see the black, which is Burlington Northern, Warren Buffett's railroad. Everything else moves north-south. The blue, CSX, the light blue, the dark blue, Norfolk Southern, CSX and Norfolk Southern. You see the red line? That's Canadian Pacific. It goes from Port Rupert in Vancouver, and it connects all the way down to the Port of Mobile. And it's merging right now with the kind of tan purple line going down into Mexico. That's Kansas City Southern. Those two railroads are merging, and they'll become the first class 1 railroad in North America that will go right through the heart of our supply chain. And if you look at these rail connections and the port connections, you will see this is why the answer to where do we solve supply chain is it's to move its anchor from LA and Long Beach really to the center of the country, the Gulf and the Great Lakes region. This is where all of our infrastructure is. This is where all of our population is. We can move things very efficiently by rail. This will put it in more perspective for you. So Retro Economics, we just did this major study. It's not been authorized for public release, but I can show you a few things that are in the report. The one I want to drive your attention to is what are inland and intermodal ports. So we introduced through the Ward Center a last mile logistics course last year. We'll be redoing that here shortly, and we're going to update it. If you look at the second graph, the map down there, and look at the blue dots are all ports. And the yellow are inland rail or inland river ways that move us with our rail all the way up into the interior of the country. As you can see from really Texas and then New Orleans, around the Gulf, through Florida and up through the Southeast, this is our redundancy. So no matter whether a hurricane hits or whether you need to move through the Panama Canal or the Suez Canal, every bit of materials and goods that we need can move really north-south by reducing our dependence on the West Coast. And I think this is what's going to play out over the next 2 to 3 years. And it'll take us a couple of years to get this put together. We're already seeing it with rail mergers and other things. And what you can see is using South Carolina's example on the right, you can see the Port of Charleston. Everything the Port of Charleston has done, it's a creature of economic development created by this legislature. And look at all the companies that have developed in the upstate, the disadvantaged areas that lost textiles and furniture manufacturing. They're all up there. They're connected by inland ports. It's a great model. We're starting to do this in Alabama. We just got approved the first inland port in Alabama, in Montgomery. Retro Economics, we worked very hard on that. It's approved. Kia and Hyundai are looking at many more plants along the I-85 corridor from Charlotte into Alabama. The Port of Mobile could likely surpass the Port of Charleston within 2 to 3 years, which is an amazing accomplishment, going from less than 500,000 containers a year, to like 3 million. Charleston's at 2.5 million a day. Port congestion, we've seen it spread beyond LA and Long Beach, but it's all relevant. When you're looking at days or 10 to 20 ships backlogged in Charleston or Savannah, that's nothing compared to 100 ships in LA and Long Beach and weeks to months to clear the backlog. And so this is the urgency. And what we're seeing in response to it is this. This is a big story for retailers. So it's not just omni-channel anymore or having a good website and knowing how to do BOPUS. It's going to be, how do you move your supply chain? And we're seeing retailers, whether it's this example of Lock Tech, a furniture retailer, or whether it's Home Depot or Lululemon, they're all buying, leasing, or utilizing these old, smaller container vessels that, to go through the Panama Canal couldn't be more than, a few thousand containers. They're buying those 1,800 TEU cargo ships or leasing them, and they're going to the East and Asia and India and whatnot, and they're picking up what they need and they're bringing it into the US. And if you come back to this slide here with the yellow dots, those are all the inland river waterways that come from our ports. These 1,800 to 3,000 TEU vessels, they can move up these inland waterways. So this is, again, how all of these pieces are coming together. If you don't believe it, just follow the earnings reports. Look at Prologis. On the right was their third quarter numbers, which were incredible. And here's their latest fourth quarter numbers. They're 97% occupied on $1 billion portfolio. They had net effective rent changes of 33%. Their same store warehouses had a rent increase, that was it was up 7.5%. And then look at their average cap rate. When they get these things valued or they trade them, they're looking at 4 cap rates. And these are in secondary markets and tertiary markets and primary markets. So industrial is not going away. We'll build 350 million square feet again this year. We need 500 million square feet a year for the next 3 years to even affect the 95, 96% occupancy rate. So I'll close with this and we'll be able to take a few questions, David. So I had a good time. I went out to the Nevada chapter and spoke, and I saw something I've never seen. So when you think you know it all, you'll discover you don't know it all. So they had a nice event in the Nevada chapter at a casino, and I went in to use the restrooms, and I saw something I've never seen anywhere in the country. They had double cup holders at every stall in the restroom. And so I asked the casino manager what was kind of behind that, being a curious economist, and he said, look, we're offering 2-for-1 drink sales to get people in the casinos, but if you leave your drink at the gaming table or the gaming areas, we have to, throw it out. So we needed to give them a way to take them into the restroom. So the lasting innovation in Nevada from COVID isn't going to be mass. Maybe it's double cup holders. But I also want to call your attention to Texas, because they are an important story as well as energy. And we haven't talked about that in a long time. It really is lights out and EVs unplugged if we don't embrace Texas and understand how important they are to our real estate economy and energy. They produce more energy than any state. They export it. They're the most back to work state. So they figured out how to get people. They were over 50% a month ago. They were the #1 state where people moved into. So even though Florida and other southern states were great, they were #1. And then don't overlook the importance of Texas in terms of the port supply railroads. They have 3 Class 1 railroads at Port Freeport near Houston. It's going to become to Dallas what Savannah became to Atlanta. If we don't understand these the hip bones connected to the leg bone, connected to the ankle bone, to the foot bone, ports, rail, trucking, infrastructure, energy. If we don't get those points, we don't get commercial real estate at all, and we don't get it for our clients. So with that, David, I'll stop and see if we got time for any questions. There again is our little company, and so I'm very grateful to my Red Shoe team for everything they do for us. But there's the cup holders. You have any? I'll stop sharing and see if you have any questions or anything we can do.
Casey, I mean, what great information as always. What an incredible way to start 2022 for us, for our clients. Thank you so much. So we're up against the hour here, but let's try to take a couple of questions really, really quickly. One of them comes from Michael Chase. It says, it appears that the last 2 times the Fed began a pattern of consistent rate increases, the yield curve went inverted toward the end of those cycles. Do you see a similar pattern, and how long before we see an inverted yield curve again?
Yeah, so I'm afraid the Fed is afraid of that. They're afraid to spook the bond market. If they see that, they're going to freak out. But I think we're going to see a very steep yield curve here, where the long term goes much higher than the short term. Investors are willing to deal with some short term increase in rates, but the long term, which drives all our commercial real estate, the Fed's lost control of that. And I think we'll see at least a 3% 10-year treasury here by the fall. And I think that we could see the following year us get into 4 or 5, maybe even a 6% 10-year treasury. But I don't see short-term going above long-term.
And then how is the CREPI index actionable? And what does it mean for the future if it goes up or down?
Good question. So what I'm going to be writing is, as we get the index and we see what the new score is, I'm going to tell you what caused it. So if it went up, was it employment data? Was it inflation data? If it goes down, was it a loss of consumer confidence? So we've got all the pieces in there. We got small business confidence, home builders confidence, the Michigan consumer confidence. We've got the JOLTS data, which is the best data because it looks at the labor turnover. We got a record 4.5 million people quitting right now. We got 10.5 million jobs in there. So I'll write the narrative that'll kind of put that context together. And what it's kind of like the VIX. It's going to tell us which direction we're going from a broad base. It's really easy to understand. Unlike the Fed, we're going to tell you the 10 data dependent items that we're looking at. We back tested them. They're reliable. And I really think for the Institute, this is an area and a time for us to shine in leadership on that.
Casey, thank you so much. Thank everybody for being on this call. If you have more questions, you can certainly send them in. We'll try to get them answered. I can't promise, but we will try. And this will be, as a reminder, this will be in the members only section of CCIM.com. So we will absolutely be able to review this again for a period of time. Casey, thank you so much. Thank you everybody for being on this call. What a great way to start the year, and we will see you soon. Take care.